The Federal Reserve. We begin this hour with stocks approaching record highs as investors quickly move on from trade worries. Jim Bianco of Bianco Research pushing back, writing on X the following: I share Powell's worry about tariff-driven inflation as the economy appears to be okay. I do not think the Fed should cut. Jim joins us now for more. Jim, welcome to the programme, sir. What is the most convincing argument for you right now to lead you to believe that this tariff-driven inflation is just around a corner?
There's a number of services like Trueflation and Price Stats that scrape data off the internet and aggregate like a daily CPI number. They're up 1% in the last 2 months. We didn't see the data show up in the May CPI report, but I suspect we're going to see goods inflation jump in the June CPI report and in the July CPI report as well. And so I think somewhere what they're showing us is prices are going up, and it's going to have to show up in that data. And
Jim, you know the pushback, the counter-argument to all of this. The labour market is not strong enough. You won't see second-round effects. Move on. Look through this. What's the counterpoint to the counterpoint?
Well, yeah, the labor market is moderating a little bit, but I don't think we're going to see enough of it to basically offset it. And what we're going to wind up with, look, what we're talking about now is about 2.5% inflation. And I'm suggesting, especially if you look at what's called the base effect, that last year's inflation number was 0, that you're probably going to move towards 3. And if you're going to move towards 3, that's going to be enough to keep the Fed on hold. That's going to be enough to say that fair value on the 10-year note is around 4.5%. So you'll get some moderation in that stuff, but that's why you're only going to move to 3, and you're not going to move to anything more significant than that.
Jim, it seems like the market is pricing in almost fully a rate cut in September. What happens to the long end if that happens? We've been asking this question repeatedly, and it's a real question that speaks to your belief, which is we're in a higher inflation environment. Do you feel that if they cut in the near term?
That's what happened last year. When they cut September of last year, the market, the long end rejected it because it went up over 100 basis points over the next 3 months. It all really comes down to how does the market view the environment, and does it think a rate cut is appropriate? Now, the problem is we're seeing more and more that it seems like it's being political as far as whether or not the Fed should cut rates. You've got the parlor game getting played. Who's going to replace Powell? They're all coming out, whether it's Kevin Hassett or Chris Waller or Michelle Bowman, who are on supposedly the short list of who President Trump is considering to replace Powell, all trying to one-up each other by saying we need to cut faster and sooner. And it sounds more like it's a political thing to kind of get into the graces of President Trump than it is to make economic arguments. If it is political, then you could see a repeat of last year. You cut rates or threaten to cut rates, and you'll produce higher long-term rates. If the market is in sync with that belief because the economics dictate it, then long rates will fall with the Fed cutting rates.
Well, it seems like right now an increasing number of Fed officials are looking to the July 9th deadline to understand exactly what the tariff rates are going to be. How relevant is that, considering the fact that you think that there is this sort of underlying inflationary environment at really any tariff level above 10%? I mean, does it matter if it's a lot lower than people previously expected?
Well, yeah, that and also non-tariff barriers and how they're going to work those out and whether or not they're going to bring down enough of those that even if the tariff rate is above 10%, that the all-in cost kind of gets moderated. But you're right. I think that, if the July meeting is in play, there's 3 events that are going to come real fast. A week from today is going to be the payroll report, July 9th with tariffs, as you mentioned, and July 15th with CPI. If any of that data is perceived as being weak or maybe, less inflationary than I think you're going to see, again, going back to the political Fed, a scream that we got to cut rates right now, and we could put that July meeting into play in the next couple of days.
Jim, yesterday the president once again criticized Jay Powell. He said we have to get rid of this guy. He's not doing the job. Who do you think would be, after those list of names that you and I both know about out there in the press, would actually be seen as credible to the market?
Well, other than the president himself, I guess that it would be Chris Waller, current Fed governor, Kevin Warsh, who is a former Fed governor, seem to be topping the list, as well as Kevin Hassett as well. So those are probably the big 3 names, with Scott Bessent in there, although I think he's more of a long shot, and David Malpass of the World Bank. Those are the names that are being thrown around.
But Waller and Warsh, Waller
yes.
and Warsh are currently not working for the administration. Someone like Kevin Hassett works for the administration and goes on a lot of television networks constantly and just touts whatever the president wants. Does he actually seem like a credible voice?
Well, he is a credible voice in that, or he's a credible candidate, I should say, because of his background and, you know, his training. So he would be a credible candidate. But I would also say that there's another issue too, that if he were to pick, the president were to pick somebody like Michelle Bowman or was to pick Chris Waller, who are currently on the Fed, I think he's basically picking them to basically say, burn the thing down right now before you even become the Fed. I want the rate cuts in July. I want the rate cuts in September. If you have to hold the FOMC hostage right now to get it done, that's going to be the Hobsonian bargain that they're going to have if they're already on the Fed. If you pick somebody who's off the Fed, all they can do is go on TV and scream for it. They're not actually in the room and could actually twist arms to make it happen. So this is why I fear that we're about to, or at risk of leaving the realm of economics and entering the realm of politics when it comes to what the Fed's going to do for the second half of the year.
What do you think the consequences are of that, Jim?
If the Fed is going to be political, meaning that they're going to do something that is not in sync with the economics and is in sync with the politics of what the president wants, then I think you could see long-term interest rates, especially like in the 10-year note, shoot right through 5%. It won't like it. It'll say you're stimulating when we don't need stimulation. You're going to create more inflation. You're going to create maybe a bubble because you're going to make money cheaper when we already are at an all-time high, and it's not necessary to fan those flames even more, if that's the way the market views it. Now, if the data does slow down enough to support those rate cuts, it won't do that. But that's really what political means, is that we're going to ignore the data and we're just going to do what we want to do. And the president seems to be arguing it that way too. His argument is we want to lower interest costs. Okay, I want to lower my interest costs too. I want my mortgage rate to go down, but that doesn't, I don't wish it down. I need to have a better credit rating to get my mortgage rate down. We need to have the economic data justify lower interest rates, not that we wish to pay less than interest costs, which seems to be their main argument.
If they go too soon, you might see actual mortgage rates go higher. And that could be another problem. Jim, thank you, sir. Jim Bianco there of Bianco Research. This